Hello, I'm David Frazier, the President and Chief Market Strategist of IntegrativeInvesting.com. We're recording this week's weekly video on Saturday, April 7th at around 7 o'clock in the evening. Generally speaking, I will usually record these videos and upload them to our internet website at around 4 o'clock on every Saturday. However, today I did quite a bit of research going through my tactical asset and sector allocation model, which I generally do at either the end of every month or the first week of every month. And that takes quite a bit of time. It's something that's very, very important for me to have a good grasp on what's occurring in not only the United States economy, but throughout Europe, Brazil, China, India, Japan, and really all around the globe. So, I need to know these things so that I can guide you, our members, in the right direction. And what I found in going through all of the indicators today that compose that model is that my opinion is based on the readings on the statistics that compose that model, is that we're probably going to see stock prices in general trade in a volatile sideways pattern over the next few weeks and very likely over the next few months even. As I discussed last week, numerous technical indicators, that is, statistics that reveal the internal trading action in the financial markets, had indicated at the end of last week that we were likely going to get a sell-off in the U.S. stock market this week, that stock prices here in the U.S. would likely move lower. And that turned out to be correct. Those of you that were already subscribers to our monthly newsletter as of last week realized that that I advised you this past Monday to sell all of your holdings in our core investment portfolio and to get out of several positions in our speculative portfolio. And it looks like at the moment that was a good call. I say that not just because stock prices moved lower last week, but as a result of this employment report that we got on Friday, which showed that new job creation here in the United States was approximately 43%, was approximately 43% less than Wall Street analysts on average had forecast. And a lot of people unfortunately listen to these Wall Street economists. And I say unfortunately because I have found that you might as well just toss a coin. It's 50-50 at best on whether or not these guys are going to be correct in their forecast. But because a lot of people listen to these Wall Street economists and analysts, and that the non-farm payrolls, the number of new jobs that were created in the non-farm sector of the United States, was substantially less than what those economists on average had expected, I think we're probably going to see stocks sell off pretty sharply this coming Monday. That's not going to hurt us at all because we're sitting in cash right now. We have about a 30% gold short position in our speculative portfolio, and I think approximately 10% long positions in stocks in that portfolio. But other than that, we're heavily in cash in that portfolio, and we're 100% cash in our core investment portfolio. Anyway, enough about last week. That's already in the past. What are we going to do going forward? Well, this coming week, as I just stated, I think because of this very negative employment report from the perspective of Wall Street economists, I think we're probably going to see stocks continue to move lower. So we'll just sit in cash this week. We'll get back in when the data tells us it's time to get back in. Please keep in mind, as I've stated in several of my tutorial videos, My goal is to avoid the big downturns in the financial markets and to participate in the majority of the upturns. Now, it's going to be rare that I'm going to get in and out at exactly the right point. This past week, it looks like we did that, but that's probably going to be rare that I'm going to get you out right at the high and in right at the bottom. That's not the goal. The goal is to avoid the big downturns and participate in the majority of the upturns, to get out near the top and back in near the bottom. So, last week I talked about technical indicators, statistics that reveal the internal trading action of the financial markets. This week, a little bit more about fundamentals. And going through my tactical asset and sector allocation model earlier today, I found that that model is now indicating that we're probably going to see the U.S. economy continue to expand throughout the remainder of this year, but it's going to do so very likely at a very slow pace. The employment situation, in my opinion, based on the research that I've done, suggests that the employment situation will continue to improve during the months ahead, but will remain very weak. So, we got to be very nimble and flexible in this type of environments. Let's move to China, Brazil, India, and Europe. Brazil's economy looks like it's going to continue to improve during the months ahead, and I say that based on the economic statistics that I monitor regarding Brazil's economy. India's economy, economic conditions in India will improve during the coming months. And the same in China. I expect economic conditions to improve in China during the months ahead. Europe's a totally different situation. The latest economic statistics out of Europe that are good at forecasting what's going to likely happen in the future, not what has already occurred, suggests that we're probably going to see Europe's economy continue to slow down during the coming months. And we have some really concerning news coming out of Spain. Spain's sovereign debt situation is nowhere near as bad as Greece, but there appear to be some significant, substantial problems in Spain as well as Portugal. And it wouldn't surprise me if we hear more about that in the so-called news this coming week. So I think I'm going to stop there. Let me look at some notes real quick to see if I have anything to add. I don't think so. I don't want to get into any details regarding the economic statistics that I monitor because my thinking is you all don't want to hear about that. I don't think we need to get into any detail there. I tend to get into details regarding those statistics as well as geopolitical factors and developments in my monthly newsletter. So I'm going to wrap it up there. Let's just sit in cash for now and wait for the right time to get back into the stock market. Thank you for listening. I'll speak with you again next week.